There's more data now available on hardware performance, on software performance, on utilization. Companies can make more informed buying decisions than they could 5 or 10 years ago. So I think there's also kind of a shakeout in quality of like, all right, can that cream continue to rise to the top? Can hopefully Monta be one of those ones that is known for that quality in the industry? Is like, all right, here are the winning CPOs, here are the winning operators, here are the winning software, here are the winning hardware. And I think that'll start to continue to separate in 2026. Welcome to a 2025 year-end, 2026 year-beginning episode of In Between Charges. My name is Kevin Spangenberg, and I am joined, as always, by my co-host, Mike Hawks. Mike, how was your 2025?
It's a fantastic year. Big year.
Professionally, personally?
Professionally, personally.
Maybe why was it big professionally? One reason why, and one reason why it was big personally. I think I know the personal reason, at least.
Professionally, we pass the 1 million charges every month. We install 10,000 charge points every month as well. We hit that growth rate. I think we're pretty beyond that now, actually, in November and December, which is fantastic. And we're hitting being in America for over a year. When did we hit the 12-month milestone? Actually, that was pretty recent.
Launched in September of 2024.
Launched in September. So we're kind of a year and 3 months.
Wow.
So it's been a huge year for us, which is really, really exciting.
Yeah.
And then personally, got married.
It's pretty big.
It's pretty big. Life change. Not a lot has changed, actually.
You already lived with your partner.
We live with my partner. Yeah. Married life is, all the same, except now we're planning out milestones. Maybe that's the thing that changed, the future year. Kind of like when you set your new company strategy, the 3-year goals. When you get married, you suddenly have 3 years of goals.
Then do you change it like every year, like we do at the company, where it's or you change the 3-year strategy? Is the marriage strategy change every year? Probably not. I would hope not.
Probably not. Probably not. I don't know. Let's see. If it does, maybe that's a bad sign.
I hear a dog might be in your future.
A dog is in the future. Oh. Exactly. Our strategy for 2026 does involve a dog.
Involves a dog. Cool.
I should ask the question back. How was 2025 for you?
That was good.
So
I got engaged. Engaged. Solid. Yeah.
You did?
I did.
And then the big day is in the milestones for next year?
Yes. So...
And let me ask you this. Do you have any milestones beyond that yet? It's all building up to that one day.
No, there's a lot of things building towards that.
It's that big.
It's a big thing. And then we'll figure out what the day after.
Very nice. Very nice.
Professionally, it's been great. It's been I think the theme of this episode a little bit, we'll talk about kind of up and down year a little bit, right? I think it's in the charging industry, it's been challenging this year. I wouldn't say there's a ton of runaway success stories. Monta, we had aggressive plans. I think we missed them by a little bit, if we're honest, but also a lot of successes. We talked about the charges chart this morning, right? There's a lot of chargers coming online, 12, 14,000 per month. A lot of charges happening, a lot of operators growing. Not everybody, but we're excited to see the growth here at Monta. We're finishing the year strong with some good deals being signed and putting ourselves in a good position for a big 2026.
Yes. Yes.
So let's talk electric vehicles and charging and just recap the year and what's been going on, both at a broader level and then the EV charging industry specifically. The November numbers just came in last week, Mike. Global EV sales jumped 21% through November 2025 compared to the similar time period in 2024. They grew 36% in Europe. That's where we started. That's where we're most active in Europe. Some new standout countries like Spain and Italy, typically laggards, are now climbing up the charts. Some other countries stagnated a little bit. France, notably, is maybe one. Across the Atlantic Ocean, my
Transatlantic Alliance?
The it's fraying a little bit right now. It's holding by a couple of threads right now. But they actually went down, -1%, no growth. In fact, negative growth.
So what's that? That's like 9 to 8? Something like that. Yeah,
it's like the vehicle share, a new vehicle share of which is BEVs, which was like about 9-ish, 10% last year. Same 8-9%.
But still 3 times the size of the German market.
Yeah. So it's a big market,
but still huge.
But it's you'd like to see broader growth across the country, but you also see it's a state by state kind of development. So I think there's a lot of examples across the globe of companies and governments kind of walking back their emissions targets, maybe reducing tax incentives, canceling certain models. I think it was just yesterday, Ford canceled the F-150 Lightning. It's a real shame. But of course, amidst all this, build out continued. I mean, chargers have been going in the ground. We just said we're connecting 12 to 14,000 a month to the Monta network through our partners. And, it just might not be at the projections that companies had made 1 to 2 years ago. We've talked to hardware companies, and 4 or 5 years ago, they were selling a bunch. There was so much government money flowing to these companies, and they just thought the good times would never end. Automakers, right, were making their 5-year planning strategy, speaking of multi-year planning strategies, and planning their models 5 years ahead. And, here they are in 2025, 2026, confronting a different market and canceling a model. Or we're saying, that 2030 emission target, maybe it's our 2035 emission target. CPOs probably expected maybe more installs or higher utilization. So I think right now it's a moment when people in our industry are having to adjust to the realities of less tax incentive money or reduced emissions targets. It's not the case everywhere. France reintroduced some vehicle credits that are quite popular for lower income folks. Italy launched a program that has been super popular. A lot of these programs get money allocated, and then within a month or two, that money is gone, showing that there is demand there, right? As long as things are priced correctly. Belgium, we know, has been a surprise story as their company car schemes continue to motivate companies to adopt electric vehicles. Our home market, Denmark, was it last month when they surpassed like 90%?
Yeah, huge jump. I think it was from like 60 or 70 and then went way up past 90%.
So this year just tore off the charts in Denmark. It's almost up near Norway levels, but much faster than people anticipated. Actually, one of the rare bright spots, right, where a country's ahead of schedule as opposed to others.
Yeah, maybe also a little call out for the UK, despite a lot of the nervousness for Rachel Reeves' budget that came out on 28th of November. Surprisingly, quite a lot of benefits remained and new ones introduced for battery electric vehicles, whether you're purchasing or leasing within the UK. They are reintroducing now the road tax.
The 3 pence?
The 3 pence, exactly. And they're also doing a pay per mile. So then you would basically record the mileage and then you would send it back.
I saw that. People are like, how's that going to work?
Yeah,
are people going to be diligent in recording their miles?
Well, you hope so. I don't know. You hope so. Depends. We drive a lot less in the UK than we do in the US, actually.
Yeah. But then we know in the US, the Trump administration has infamously did away with the 7.5K tax credit in the big, beautiful bill. They tried to get rid of NEVI funds. They paused them earlier in the year, but they are now back and flowing out to states once again. And we know that there are some utility rebate programs that persist in providing funds for EV charging. So a lot of mixed signals. And then actually, Mike, we're recording this on the day, December 16th. I think you have Bloomberg app open in front of you. What's the headline that you're seeing on the Bloomberg app? Yeah,
exactly. It's something that we've been following, quite closely. And I think there's a lot of push, of course, for battery electric vehicles, plug-in hybrids, to be able to make the change. It's a pretty big change for manufacturers. They have whatever it is, 10 to 15-year manufacturing lines. And 20 minutes ago, the headline from a Bloomberg article is that the EU is to abandon the combustion engine ban in a win for car makers. And I think a little bit of that is maybe clickbaity. Nothing's been confirmed yet, but it's fair to say that there are some signals that might be shifting, moving out to the right. Perhaps we already know that Ursula and the rest of the group and the European Commission have agreed.
First name basis?
Ursula,
me and Ursula.
Ursula and I would call like this. She's not texting me back at the moment. I don't really understand why since this article came out. Perhaps making more of an average over a 5-year period. So instead of a hard ban on 2035, manufacturers would have a little bit longer to manufacture combustion engine vehicles as well as plug-in hybrids and still benefit from some of the benefits and the credits. So there is something happening every single month. It's been a big strain, I think, on the industry to try to achieve it. Everyone in the US took big bets on the large SUVs, the large vehicles, very, very costly to make, not necessarily delivering those big margins and big sales as needed. And then, of course, in Europe as well as in the US, competition from China, new entrants. BYD is also talking about building out their supercharging infrastructure within Europe that would have something like a 5-minute charging window, which is just insane amounts of power and also insane compatibility for the car.
We're going to connect that to Monta?
Of course.
Oh.
Absolutely. We've got Tesla on the Monta network. Why not the rest of BYD?
Yeah.
So no matter where you're listening to this episode, it is probably highly likely, and I guess we would both be willing to bet that there's been some changes in your local government's approach to electric vehicles in 2025. Yeah. And we have to see how that's going to shake out for 2026. But then for the charging space in particular, I think something that's been particularly true is that there is a kind of a tonal shift and maybe a shift in prioritization about what network operators are running towards. So amidst a lot of the upheaval for vehicle manufacturers' targets, there has been a big shift that we've started to notice at Monta with the conversations we have with customers and also when they're thinking about backends, vendor, charging strategy, pricing strategy. A big focus has been moving back towards charge quality and a lot of this around the customer experience. And of course, the rate of a successful charge is a big part of the experience for an EV driver. And of course, operators still want to build out their network. There's still a lot of network expansion, but I think what we've noticed is that gold rush, that land grab, that real push put them in the ground and the drivers will come. That kind of mindset and that mantra is starting to change a little bit. The first set of hardware that they purchased, maybe it was a white label that they'd recognized that they could get at a really, really good price and put their kind of own logo on it. Starting to realize, does it actually work? Can it keep up with the change of pace of OCPP specifications and also the range of MSPs and energy and battery integrations that are needed to be able to make it successful? What is it that actually gets drivers returning to a charging network? This is a big discussion we've had quite a lot of times. You know, as a SaaS company, it's great for us to understand what flywheel effects are out there so that the customers we serve either provide additional services to their customers, which then bring more users onto the platform, for example. What's the actual flywheel for an operator, and how could quality be the actual indicator for somebody? Everybody is selling the exact same product. Energy is largely ubiquitous, at least in places where we're fortunate enough to have a powerful grid.
Yeah.
But you're selling the same product. So the thing that actually keeps people back is, does this work for me? Yes or no? And then maybe secondary to that is the price. You get somebody in with a good brand, but you actually keep them returning by making sure that that's happening and discharging electricity.
Maybe a cup of coffee.
Maybe a little cup of coffee is going to be there at time as well.
Yeah.
Buy a sustainable wood canopy as well. You know, we had a conversation with Einride earlier. Some of the sexiest canopies that I think we have in the industry. Shout out to Einride.
You think drivers choose their charging site based on their canopy?
Maybe. The jury's still out on that one. I'm not really too sure.
We have a lot of data now. Say when you're buying that hardware 5 years ago, when you're making that first software buying decision, you didn't have a lot of data to go on. And you're just going on a hope and a prayer, obviously, hopefully a little bit more than that, but of what a hardware manufacturer will tell you. Yeah, of course it's going to be 97%. What a software platform is going to tell you, yeah, of course we can help your utilization go up and we're going to be reliable. But now you have years of data and you are maybe making another buying decision now.
Yes. I totally agree. And I think, remember the conversation we had with Hubject, Christian Hahn, quite some time ago? The conversation there was about plurality. To be successful in the starting point of this industry, you need to be hardware agnostic. You need to be app agnostic. You need to be, able to completely control price based on the current market rates if you have dynamic pricing. There's so many different elements that start to come into it. And I think now we're starting to see where the traffic really lies and who owns that relationship. And at the same time, talking about data, some of the companies that have a really big play on data about the vehicle manufacturers themselves. What are people's driving habits? The best-in-class maps. Where are people actually driving? What are the best and most efficient traffic routes to be able to go to? They're really starting to make some sort of a play based on the information that they already have, which poses a bit of a risk to operators. So those companies that were hot maybe 5 years ago, whether they were about to get ready for an IPO or whether they were getting ready for a SPAC, have, a few things about SPAC back in 2020. Perhaps you were getting a little bit excited about some of them that's been announced very recently.
I did not invest in a charging SPAC. I've invested in a couple of SPACs and I've taken to the cleaners, but did not get into the ChargePoint SPAC.
Oh, the charge one hit below your threshold?
Didn't show up on the random Twitter feed that I was following for advice.
There's been a shift from as many charge points in the ground as possible, growth at all costs, through to, now there's a lot more pressure on us to actually make this a demonstrable, successful business that obviously generates money. Everybody's in this industry to make money at some point, whether that's 5, 10, 15 years, depending on the overall business plan. So businesses are getting very serious. They were, of course, serious before, but perhaps a little bit more of a narrow focus on actually building a long-term successful business and what does that really look like, and trying to navigate through a much more challenging moment within the industry. And one of the terms that we've discussed about, Kev, kind of you and I, is this topic how previously incentives, funding, grants, etc. were all present. Now it's much more about entering into a moment where things are going for the market rates.
You could almost say things were distorted a little bit early on or have been weirdly distorted. And I think in markets that can always happen, right? Where there's going to be, could be government largesse or incentives that point actors into a different direction or something, into certain activities. But what kind of this made me think about, this market rate moment, this term market rate moment was, I actually heard an operator in the US the other day say, we of course focus on incentives in certain states where they're quite generous, right? In some states, they can get many thousands of dollars for like a port installed. That can cover the install, no problem. And he's like, yeah, that's great. We go after that. So that's understandable. If you put out this incentive, put out this carrot, then obviously companies are going to respond to that. And if there's free money on the table, you would be wise to go after that free money. That money's not going to be free forever. And he also was talking about the other focus, which was like large businesses and corporates where they're actually installing these on site. And that business or corporation has to pay what he calls them their market rate segment. So these are chargers going in where you actually have to sell them at a price that the market is willing to pay. There's no money here. It's like, what is Microsoft willing to pay to put them at their site? What is Marriott willing to pay to install chargers and have them be operated at your site. And that's what I think so many operators are having to figure out. It's going to be market by market dependent on how much money is on the table, the types of businesses that cropped up. I've heard, in the UK, for example, we know that prices have been driven very, very low. So businesses think that they should only pay a couple of pounds per month for either to connect a charger or to pay it as a managed service. And maybe that's the right market rate in the UK. I'm not sure. But companies now have to navigate that, whereas it becomes tough if you can't provide a quality service at that price, at that market rate. This idea of like the market rate moment or calling something the market rate, I think it does a nice job of describing the shift that is underway is like, what are businesses willing to pay for managed charging? What is a driver willing to pay for a kilowatt hour? How much patience are you going to get from an investor for a big investment? What do they need to see from a CPO to like prove out that business case? I've talked to CPOs, you've talked to CPOs, and I've asked them, how is fundraising? And they're like, it's brutal right now. It's tough when they need to see like an ironclad business case as like, what does this actually cost? And can you prove to me that utilization is going to be there? Can you prove to me that you can win that next RFP, that next tender? These are really tough questions that I think operators in all of our markets are really having to confront. So I think as we kind of close out 2025, start 2026, I want to kind of tackle some of these questions because I think they're important for us as Monta to think about, but also just for everyone in our industry to keep in mind. And I think everybody's kind of navigating this amidst all that upheaval, but there's the day-to-day of, I want to put some more chargers in. I want them to be used more today than yesterday. I want to get some more drivers to show up today than yesterday. I want another business to sign a contract today for 10 more chargers to go in than yesterday. I want to prove out my case to the investors. I want to go to them for their next board meeting and say, look, we signed 10 new projects in the previous month. That's the only way you're going to get through this right now. So let's talk about this a little bit. You mentioned the shift to profitability, this mindset shift. But Mike, in your opinion, kind of what does this shift to profitability mean in a charging context?
We were having the discussion about the impact of shifts in EV sales on operators and on their forecasts, because it's not a direct one-to-one with, I don't know, France, for example, saying that they have not necessarily grown by the 20, 25, 30% as perhaps the rest of the world has done, at least within Europe, at their kind of average of 30% from November to November. But there are still pretty decent volume of vehicles out on the road. Norway has the highest volume at 25%, and I think some of the markets are starting to come up to 12%, etc. It's not a direct translation to utilization of the network. And when you pair that with some of the conversations we have with operators that have business plans that last 10 to 15 years, you can still only assume that a lot of the leading indicators that they have, the units that they're looking at, is how many cars are going to be on the road at this time and how much will that basically convert to utilization. Yeah. So whilst it's not an immediate shift or an immediate hit necessarily on utilization, it is something that they need to be able to readjust their business plan and their model for over the next 10 to 15 years. So I think that's one of the things a lot of companies now are looking back at their investor plan and also their time to profitability and starting to work out, okay, what needs to be true in order to make us profitable or some sort of other exit by the kind of 10 to 15 year milestone. The other thing is there's been this mindset, as we talked about before, of growth at all costs, put the network out, put the charge points out, the drivers will come. So there's been a lot to celebrate out about how big the public charging infrastructure has become within Europe. We're over 1 million charge points. There's also tons of semi-public workplace depot fleet charge points as well that are much harder to really understand how many they are on a market. With that also comes increased competition about how much you will actually get drivers coming back to your individual network. Yeah. And then maybe the kind of third thing is, it's like, where is your actual customer base, your profitability going to come from? Because a lot of people will be using the same network, the same charge points all the time. Their kind of preference index will be close to the same charge points. Every now and then they would go somewhere else.
Near where they live.
Near where they live, near their supermarket chain, near their kids' school where they drop off, near the basketball courts or football courts or wherever it is that
that's
you're
not going to change
people
too much.
off.
I mean, people move, but
people move, right? But also,
not when the interest rates are this high, you got a nice locked in a low interest rate.
Yeah.
You might be staying put for a while.
Especially with what's happening now, I guess, if people are looking at the rate cuts and everything else, people are probably going to be like, you know what, this charging network's fine. I'm not going to move for a new charging network. Maybe that does happen. Who knows? Okay, but then basically that means there's increased pressure on the business model for an operator. And there is increased scrutiny on where do you have sites that are delivering good utilization and what part of your portfolio is maybe underperforming, and understanding why that basically is the case. And once you have a hold on that, working out, okay, what's the next funding plan over the course of the next 10, 15 years or so. So then it's like you're going through the logic of trying to understand, how do I translate the successes, where a lot of it could be about location, but it could also be about site amenities, accessibility, volume of charge points. How do you translate that to sites that are perhaps underperforming Or if you can't do anything about that, how do you inform better choices about the sites that might already be in your pipeline, the type of host that you're trying to work with? And the conversations that we've had is a lot of operators, they simply don't understand or can't see what performance metrics are changing. When I change a price, what impact does that have on demand?
Yep.
When I'm actually looking at 20 vehicles at my site and I don't have the right load management, how much am I actually missing out on because I can only support 9, 8 vehicles or whatever it is at one time? We went on a bit of a drive for our marketing team offsite, and we sat at a charge point where there were already, unfortunately, 3 other taxi drivers enjoying a really nice charge.
And we did not enjoy a nice charge.
It was for a 150 kilowatt charge point, we maxed out at something like 49. So if we wanted to get to 80%, we'd be sitting there for a long time, and we would not enjoy the Samayan cocktails that you're already conjuring up for the rest.
And we would never return to that charger ever again, because one bad experience, never again.
Yeah, it did work, to be fair. It worked first time.
Worked first
it was
time.
also a monster charge point.
It did
work first time. That's a big shift. Like a shift to profitability means what is it that actually drives good performance in my network, and trying to really understand that at a detailed level.
One of the big reasons that they're pressured to optimize their network is that there's not as much money floating around for DC fast charging right now. There just simply isn't, because this case has been tough to prove. I've talked to CPOs, you've talked to CPOs, and I hear it's a pretty brutal fundraising environment out there right now. And secondly, a lot of the money that maybe was going to them 5 years ago when it was going to these companies that SPAC'd or IPO'd and there was a lot of hype around it, that's been sucked over to other places. It's going into the AI, but you can't really talk about this without a little bit of an AI element, because frankly, so much effing money is going into AI. It's crazy. And so if you're out there and you're like, hey, I'd like to get some million to put in a few DC fast charging sites, like, you are low down on the pecking order of investors. There's a gold rush going on, and that gold is not in DC fast charging sites. You can still talk to investors about this, right? But you have to have like a rock solid case. And so people are looking at this and they're like looking at portfolio sites and they're saying, what's your utilization for the past 3 years? Why is that going to be bumped up to 25% over the next 3 years? What gives you the confidence to say that? And if you can't make that case really rock solid, then investors are going to go somewhere else with their money. And so it's like this shift to profitability. It's like, can I prove this? Can I really prove that I have 100 chargers, 200 chargers, 500 chargers, whatever it might be, and that this business case is working? I'm able to get a margin. I'm able to keep my costs low. I'm able to bring in repeat drivers. I'm able to show increasing utilization month over month. That is going to get the eyes of investors at some point. There are investors that would be interested in that, right? I think there are. But it's a tough case if you have to go to them and say, yeah, we've stagnated for the last year, and there's no really reprieve coming. It's a tough case to make. Let's talk where the money at is in this sector. Let's kind of look back at this year a little bit and see kind of like how different areas of our industry have performed.
Yes.
Because this is a question that we now ask at the end of every episode. We ask our guests, if you had $10 million, 10 million euros, if they're from Europe, dollars if they're from America, to invest in the EV charging industry, where would you invest it? So maybe we can use that to kind of structure and frame a little discussion here, because I think this, amidst the macro upheaval that we see from governments and automakers, there's also been kind of some upheaval in our industry, right? The last events I keep going to for the last couple of years, EV events, everyone's looking around, they're like, who's going to make it? Not all the hardware companies here can survive. Not all the software companies here can survive. And it's true. And some this year have actually not survived. So maybe we'll just divide it up into a few different sectors here, Mike. But let's talk first software charge point management system. That's where we are. We're a little biased. I do think there is a business here. If you were to invest $10 million, we won't do that. Well, I don't have $10 million, but do you think there's a business here? If we didn't think there was a business, we probably should find different jobs. What's kind of clear here is what's a nice, double-edged sword we talk about a lot is any CPO, any operator, any solution provider, AC, DC, level 2, level 3, they need software to run their business. That's the nice part. So whether it's Monta, whether it's another provider, they have to connect their charger to an OCPP backend. You need to provide pricing. You need to sell that. Then it kind of becomes a scale game. Would you agree? Obviously, we don't start to play in other stuff. We have started to play in some other stuff as we achieve certain scale, but it's a scale game, right? We want to connect. We want our partners to connect as many chargers as possible. They pay us a monthly subscription. We can also make money on the transaction fee, but this software is needed out there. And there's a case if we're like any other business, if we can sell a charger subscription for more than it costs us to provide that subscription, then we can be successful. Do you agree with that?
No, I agree. I think software is the way to connect this new interface between the charge point and the grid, or whatever asset is out there and the grid. And that's not existed before. And I think the part that interests us most, and also when we've been speaking with, also some of our competitors out there and other people who are particularly interested in getting started in the space, is what will the energy industry look like as vehicle to grid, vehicle to home starts to become a little bit more commonplace, and people start to then actually shift their kind of perception of what consuming electricity actually is.
Yeah.
It might not necessarily always be the big revenue driver, but we're seeing it already that people can get a pretty comfortable kickback from the energy that they're selling or how they're participating in confirming that, they are trading renewable energy for their vehicle. In Germany, it's like 300 euros per year from greenhouse gas emissions. That's not a small amount. And there could be more opportunities for that in the market. So software is the way to connect all of those assets. And I guess at the moment, everybody is trying to solve a particular problem. And at some point, we feel that there'll be conversion.
Yeah.
We were talking a little bit last week about energy management and how, smart charging now for us is moving out of the home and also more into the depot and the commercial charging space is kind of, we can introduce more complex ways of making sure that people are consuming electricity at the most effective time or maybe at the most attractive time for renewable energy. I think something within software that I find particularly interesting is, obviously, as you said, we're biased, but we also can't say that we would invest 10 million in our own company if there's going to be another company. Mm-hmm. I think one thing is some sort of, and there are a couple of companies out right now, they are operating an energy marketplace where businesses can actively trade power purchase agreements, and they can also participate more closely day by day with the type of electricity package that they're getting. At some point, it will probably be regulated, but for a company like Lego, for a company like Fastned, they can already start to differentiate by proving that they're trading 100% renewable energy.
I think one thing to note about the software space is that you are heavily dependent on the growth of your operators. Right? At least right now, when it's still a volume game and a subscription game, and we're not necessarily quite trading a ton of kilowatt hours and able to really play on all the interconnected assets here. But when it's still kind of a subscription revenue grind, is that you're dependent on so many other factors. You need that CPO to go win that next tender. If they lose that tender and it goes to somebody else who's using a competitor software, they get those 250 charge points and you do not. And you miss out on that growth. You're dependent on that CPO proving out that business model that we just talked about a fair bit. Can they actually do that and prove out that business model? Or do they have patient investors that believe in that business model, that are willing to provide some more financing for the next round of 10 DC fast charging sites? We've seen churn. We've seen companies have churned and they're not using anymore. Sometimes it's just a business decision. We're also at the whims of, you sign a big company that's a subsidiary of a much larger conglomerate and the parent company says, no, we're cutting out EV charging. So I think when you're selling software, you're going to be dependent on that company's performance, right?
And also, there are a lot more charge points coming online over the course of the next 10 years, even if something like the CO2 emission standards start to be pushed back. And It's like, is the market big enough? And is there actually a company that is capable of dealing with that type of scale?
Yeah.
If we look at, I know we don't talk about the Chinese charging network a lot within these kind of podcasts, but we were looking at T-Good, the utility company, and Tennu Energy, their charging subsidiary. They operate over 530,000 public chargers. So that's over 10x our largest network that we have basically on the Monster platform. And so there's a long way to go. There's a big set of scale. For China, they haven't yet reached their kind of peak installation rate. And in Europe, we definitely have it. In US, that's also kind of yet to come.
Yeah.
So between now and 2035, this industry, this market itself needs to 5x, 6x to be able to get to the charging capacity that's needed. So when you're looking at software, you're also like, this market is huge. The potential here is really big. What about hardware? Kev, you were talking a little bit earlier about the types of brands and hardware companies out there too. They were seeing this as a bit of a gold rush. I mean, what's your point of view on hardware as an opportunity?
That's where I'd go first and foremost. All my money in hardware.
Oh, really?
Yeah. Building a DC hardware manufacturer. Open up a little factory in northern Italy. And
Sense a little sarcasm.
I think the hardware game is quite difficult. There's a lot of brands already on the market. There's a lot of brands in all of these areas that we're going to discuss, but you're up against oftentimes some kind of big industrial giants that have long-standing supply chains and technological know-how of how to put these things together. Siemens, ABB, Schneider. They don't necessarily always produce the best charge points. It's not a guarantee of that, but you're coming up against them. In addition to that, there's specialist brands that are solely dedicated to either AC or DC charging that have been around now for 5, 6, 7 years, that have big factories, that are churning them out, that have hundreds of thousands of units that are out there in the ground. AC chargers are pretty simple. DC chargers are very, very, very complex kind of machines and take quite a bit of know-how and mastery to really build and get out there at scale. AC, it's a volume game, just like we're talking about. DC, you're going to be up against Alpatronic. We know that. You're going to be up against ABB, Siemens, these ones that are making these at scale. And we've seen quite a number of both both AC and DC operators like already fold in the last year, right? We know EVBox is the notable one. NLX, they discontinued their manufacturing. So, we know hardware is also just generally a lower margin business. $10 million is not going to get you very far in hardware.
I think also hardware is, if we was looking at 10 million investment, it would probably be in a company that's leading on R&D. Those companies now that are trying to work on megawatt charging, high power charging for the heavy duty vehicles that are coming out. Those types of manufacturers, at least within Europe, that are going to compete with the BYDs when the kind of innovation pathway ahead of them is basically how much power could you put out and how quickly could you charge a vehicle. That kind of seems to be where people are really competing on. Mm-hmm. And then, of course, with that comes a lot of, you need to make sure that the right vehicle is compatible and everything else. If there was going to be an area, it would be in those types of companies that are really pushing it.
All right, Mike. So if you had $10 million, would you invest it in operating an AC charging network? And what would you be optimistic about? And what would you find challenging?
Yeah. So yes, I would. However, with the understanding that it is definitely a volumes game, and also, as I kind of started to talk about before, I would want to spend a lot of time researching and understanding like who is becoming specialists within their particular stage within the value chain. Are they a business that is upselling energy services and they're using charging either as an entry point or as additional kind of bolt on to that, but their charging sales is a core part of that business? It's not a side business or a side hustle. Are you really focused on retail, and as a result, you know that the charging network you're setting up is an extension and an association of your brand to be able to keep people comfortable when they're coming to your parking areas, and also then of course they're purchasing more of the consumable items? Or are you a company that's really focused on real estate, for example, and you're kind of trying to ride the wave of the renovation law that's coming up? So I think that would be an area, but it would be an area that I'd be very, very cautious of choosing the right company to really invest in. Companies that can essentially keep costs super low whilst running a few thousand charge points with just a few people. We mentioned the example a few times, but Zap Mobility in Denmark, I think it's a great example of winning major tenders and remaining very relatively lean. DC, we know, is a very different game, very different ball game. What do you think about investing in within the DC market?
I'm all
DC
in.
Operators.
I'm all in.
Chips are all in.
Chips would go all in on DC. No, I mean, as you know, I have brought my family into the DC charging.
That's the first time that you're announcing this.
I have not talked about that. No, I have brought my family into the DC charging ecosystem. I'll talk about that more at length at some point when things are up and running. Right now, it's still a little tentative, still working through some things. We talked about this before. It's a site selection game. But what I've seen in a number of different markets is if you get that site selection correct, this can start to really print some money. That's why I'm bullish on it. These sites are getting snapped up right now in every market. The good spots, those are not going to last forever. 10 years from now in Belgium or in the Netherlands, I'm frankly surprised there's still spots available in the Netherlands or Belgium, right? Those are pretty freaking small countries and they have like Fastnet and Allego come out of there, right? But in other places where it's not built out, urban areas, I saw a post from an American operator the other day that said in the cities of Pittsburgh and Kansas City, there were no fast charging sites in the downtowns of either of those mid-sized American cities. And I was like, what? There's no fast charging sites in downtown Pittsburgh or downtown Kansas City? And these guys installed them. And I was like, wow, they were first to that. That's awesome. Now they get to be that. We've seen with Stella Energy, right, here in Copenhagen, they have these awesome sites in downtown Copenhagen, and those sites do very well. Now, you got to keep your costs low. I understand if you got to get some good electricity prices. But if you get really great sites, those can just print money for years to come. And now 10 million, depending on the sites can cost hundreds of thousands of dollars, right? So 10 million is going to get you 10 to 20 sites max. But I'm not trying to become super rich here, Mike. I want to be comfortable. I want my kids to be comfortable. Not my grandkids. They got to work for it. But my kids, I want them to be comfortable. And so I think 10, 15 DC sites would make my kids comfortable and keep my grandkids hungry for a little success. And
I was going to say, don't keep your grandkids hungry. They need to be hungry for success.
Hungry for success. I don't want them to be hungry. But I think these sites, I think they can. I think we've seen evidence of it across a few different markets. Is a great DC site. If you can get hardware that works, fleet arrangements that drive utilization, become known for quality charging experience by local drivers, I'm in on DC charging. So take my money, DC charging. But if I had 10 million, take my money.
But maybe then with DC charging, because how do you evaluate a company or someone where you kind of take luck out of the game? Because I think We talked a lot about Waymo and some of these like AV ride companies that are starting to really kind of crop up, and they're like, okay, we'll take this site for now because it's in a convenient location for our company.
It's in downtown Dallas.
Same thing if, I don't know, there's a disruption on one of the main highways, and as a result, the fleets are kind of diverted via your charging network, and then people come across you. Like, there seems to also be a lot of luck in the game, particularly now some of the hot sites are starting to get kind of snapped up by others.
Could use stable auto. So if you hope the autonomous vehicle company is scouting out your area for months at a time and launches in your city, that's a little lucky, right? I've seen sites perform well in areas that you might not obviously anticipate. And I'm not saying it would be cake at every DC site. We've seen plenty of DC operators where their sites are not printing money. We've seen that. But I think we've learned enough by now, and I think these people put it together, the Stellas of the world, the Uno X's of the world. These companies have learned what goes into site selection. When we were driving up to that marketing offsite, there were Uno X locations that didn't have EV chargers. And I would assume there's probably a reason for that. Maybe they'll eventually become an EV charging site, or maybe they'll shut them down because they're like, that site's not going to be good. So I'm saying, give me the 10 good sites. No, again, are you going to be able to prove that? That's exactly what these people are facing right now when they're out there struggling to raise funds, is because they can't concretely prove that out right now, that are these 10, 20 sites going to be bangers? That's a tough thing to prove out.
Definitely.
There'll be risk in any of these investments, right?
Correct, exactly. There'll be risk in any of the investments. But I guess also you have maybe a little bit more to play with as well, with kind of customer engagement and owning that app experience or something like that, or trying to partner with other types of organizations to be able to get your charging network kind of promoted out there. So to try to, I guess, reduce the element of luck and be more intentional.
If the driver support calls in, they'll just give them a free charge. If they can do it, they'll just fire up, say, I'll give you a free charge. It's because, you know what, this giving you a free charge and have a good experience so that you come back is worth it right now.
Yeah,
I'll take the $20 hit.
Exactly.
Okay, so I'm all in on DC. I know there's some risk there, but if I have 10 million, I'm all in on DC. Let's talk data plays, Mike. And we've heard this from, I think Rohan mentioned was data was where he would put his money. I think Gideon Van Dyke also said that something around data. What I think is not clear to me is what data is valuable yet in this space. What's the dumb cliche? Data is the new oil. It's all great. Data is what you should be trying to hoover up. We sit on a lot of data at Monta. Sometimes operators want more data from us. They like it, or they're very happy with the amount of data that we provide them. There's driver data. There's charge session data. There is charger performance data. And in many industries, what is really valuable is user data. That is what people use to target with ads. That's what people use to, well, basically everything's ads, right? What would you invest, if you wanted to invest $10 million, would you invest in some sort of data play in the EV industry? What data are you hearing or thinking is the most valuable for a software company, for a hardware company, for an operator? What data is truly, truly valuable in our industry?
Yeah. Very difficult question, because it's like, what data is valuable and also for whom? If you're an investor, the data that you're really interested in is, how can I evaluate the portfolio of sites for whether they will increase, decrease in utilization over time, and what's the type of competition going to be like? And that's where, stable is particularly strong. We know there's this many traffic. These are the social demographics, etc. This is what you might basically have within 5 to 10 years. But I think for operators, perhaps the data that's the most interesting is the one, or is the set of information that either opens up new use cases for them, or it's the data that helps them to turn the needle on utilization, playing around with pricing, this type of stuff. And I don't think there's like a specific data play that exists like that for the industry right now, other than relying on the vendor or the backend that you're currently working with. I think the first part about data is just making it visible and reliable in a way that you can easily start to spot trends and patterns and everything else. And I think it's probably underappreciated at the moment how much of a challenge that is for operators. Actually being able to say, if I tweak the price up or down by 10%, this is the elasticity of how many drivers come to my network or they don't. So that's not necessarily a direct answer to your question, but I think it's just like there's a lot that needs to be done with data and kind of surfacing it basically for operators. And then I think the other part is trying to open new use cases. I'm still a firm believer in, when we look at our network, there is a minority of the vehicles that are driving the majority of transactions within your charging network. So if you understand and are able to start to target those types of fleet organizations, those corporate fleets, those last mile delivery companies, and really help them to understand what they're looking for, that is where you can start to see some real spikes, and not just spikes, but also considerable increase in revenue over time. And that requires integrations with the vehicle, that requires integrations with the energy management system. So I think integrator companies that are providing some sort of data play by being able to make OEM vehicle information available, state of charge, et cetera, to operators, that's something that's quite interesting. And then maybe also these kind of, I don't know necessarily if there's like a integrated play with being able to connect different types of assets under one roof. So you're starting to pull in, exactly as we talked about before, like batteries, solars, et cetera, within one play, and being able to kind of turn the dial and thread the needle on some of those. I think that's perhaps the most relevant data to operators right now. Some kind of backends provide it. Others, you need to work with a third party to be able to bring it in. Also, some are market specific, and there'll be kind of, people who will be particularly strong in that. I agree with your point. It's really hard to actually say what is valuable data.
Yeah.
And I also get a little bit allergic when we start to think that every type of SaaS company, what is it? You either die a heroic SaaS company or you live long enough to sell ads.
I think a lot of the useful data, though, does come back to us, to be biased for a second.
It's like, exactly, yeah.
Because we're the connection piece, and there's the driver that's charging, there's the connected charger, and we're sitting at the center of that. And some white label deals, they'll get more data, right? And then some is less, but it's like, at the end of the day, we actually do sit on a lot of this data, and the way it's going to be used is going to be very interesting going forward.
So we talk about the data and what helps an operator to kind of turn the needle on utilization.
Sure.
There are tons of other things that fit into the driver experience. So how are you engaging with the driver? How are you supporting the driver? How are you starting to pull in other types of integration services into your app? How are you displaying amenities? How are you making them discoverable? There's something about this ecosystem of operational add-ons that are basically starting to exist or kind of occur within this industry. So we work with Uberall, for example. Ampasist has very much a focus on load management, grid management, et cetera. What do you think about this kind of broad categorization of companies that have some sort of stake in charging?
I would probably not put $10 million into them. It's no DC charging operator, in my opinion.
You've already spent your $10 million.
I've already spent my $10 million. Wait, if you'd asked me before, maybe they would have gotten it, but I've already spent it all. I think it's an example of a maturing industry where you get more players coming in that are filling out this ecosystem and realizing that, there's a gap there. There's a gap for spotting failures and getting maintenance on site a lot quicker. So is there a business there? There's a gap in the driver support because drivers are getting abandoned and stranded and, frustrated. So can we provide you an add-on to do that? Because that's not your core business. You're a DC fast charging CPO. You're good at finding sites, installing sites, running a network, but you don't want to do driver support. So it's an example of the ecosystem kind of maturing and filling out, and we see more and more of these kind of come into the game. It can be a tough sell for them to go in and pitch yet another element of the tech stack. So some companies are very comfortable with this. If you're like a more mature utility or something, what's 5 more euros added on top of a charge point per month? Maybe it's a very small piece. But if we are talking about pure play operators, when the margins are thin, I've spoken with operators where some of these add-on services will come in and say, that's another 5, that's another 10, that's another 15. And if you're not able to really, really show that value for that extra 10 euros a charge point, well, that's a tough sell. So all these operators are trying to figure out what's that ideal tech stack that they're trying to put together here to offer an adequate, in fact, a market-leading charging offering. And I think, to be quite honest, if Monta does our job of making sure the charging works, if they chose good hardware and Monta does its job and the vehicle works and the drivers works, well, there should be no need for this. That's an ideal fantasy land world. Mm-hmm. But ideally, the charger's online, the charge works first time, the payment works, and then the driver leaves with a full charge. In that case, support's not needed. Maintenance isn't needed. And there's no troubleshooting needed because it all worked. So I do think that if you can get the tech stack working the way that you want it to be, then there is less of a need for this piece, but there probably always is. We're never going to get to a land of 100% successful charges. So there's room there, and it's evidence of like this ecosystem maturing a little bit, but you are adding on another cost to an existing stack that is going to be difficult for some operators to stomach.
I think I agree. And I think also what we've seen, at least in the last 5 years, because I guess what we're also talking about with these add-ons is they are like a derivative of a software company that have a really specific play, or they are someone who is playing a particular role in the charging value chain as you go from hardware through to actually kind of discharging the energy. And I think what we've seen is as soon as you start within one charging use case, there is always a need for the next step that's adjacent. And there's this natural convergence then on kind of bleeding out to playing a role with how do you integrate the hardware, how do you then balance across the grid, and then how do you basically ultimately kind of discharge energy. So these could be targets for companies to try to build in if it's a capability that's needed, but yeah, I tend to agree. I don't know if I would be spending my kind of 10 minutes.
Well, I mean, it's like we were talking about yesterday, the new energy management that Monta's rolling out, right?
Yeah.
Well, there's other companies that do solely energy management. We don't necessarily consider them direct competitors, but our head of energy management said, no, we consider them a direct competitor. That's, I guess, a result of Monta trying to do a lot of different things. But so, and we also have driver support. So, and there's others that offer driver support, and we have a chatbot. There's others that come in and add a chatbot. So it's going to be a question of who can actually do this well. And maybe it turns out that our chatbot isn't great. Or maybe our support doesn't end up being great and we actually do need to outsource that. Maybe that's not one of our core pieces that we should be offering. And we actually say, hey, you know what? Go with these guys. They're so awesome at providing a great driver chatbot. And we do that. But that's going to be for us to figure out as a business what we want to do. And then also for the CPOs to figure out how do I provide the best experience here and keep my margins, healthy.
So DC public charging, yes. Operating AC, maybe, if they have a real strong niche and they are a reputable area.
Yes.
They have a very good reputation for quality within their specific area, maybe even within their particular country.
Yes.
Data plays, not so much. Operational add-ons, also not so much. I think that's also quite a broad group, so it's kind of hard to break it down into one specific.
Sure.
And what was the other one that we talked about?
Software and hardware.
Software and hardware. Look at that. Software, absolutely, yes. Hardware,
and we didn't even touch on a few areas, such as like the EMSP space, roaming space. So there are a lot of different companies trying different things.
Roaming, we need a specific episode on that at some point next year to really kind of break that down properly.
Yeah. Let's talk about 2026 a little bit. We don't need to get into too crazy a prediction mode or anything, but we have operators continuing to scale. It's been a challenging year, but operators are still scaling. They're going from 1,000 to 2,500, from 2,500 to 5,000 to 10,000 to 20,000. What does this look like in a year as companies continue to scale? Is it people really taking our lessons to heart, focusing on what they should focus on, staying in their lane? Is it companies still trying to grab at and do a lot of different things? Are the same challenges there in a year that they are now? We're providing driver support, keeping uptime, putting in place agreements. What are your thoughts on 2026?
In 2026, I think it's still going to be a tough year. It's going to be a tough year for operators. Part of the shakeout and maybe some of the consolidation and then also the kind of introspection for operators when they've been looking at, okay, where do their costs really sit? What type of company and what do they want to be known for? I feel like that will continue. And at least from when we look at the average and then the kind of upper percentile, the upper quartile, the companies that are performing particularly well are those that are able to grow their network without linearly growing essentially their operational costs. Whether it's the number of individuals that's needed to be able to manage the volume of failed charge signals, be able to implement OCPP, be able to manage kind of support requests for drivers, be able to custom build ways of pushing a notification to a driver to bring them to their network. And part of that, we believe, is how are companies using technology to be able to do that in a much better and a much smarter way. So there is a part of growth who's going to be kind of capturing that. And then maybe for 2026, the other piece that I would love to start seeing is more experimentation with what actually turns the needle on demand. What is it that you can really correctly and accurately say, this is the difference between a driver choosing my network or a driver choosing another network, for if you're a public CPO, or if you're more of an AC operator where you've chosen your specific niche, like this is what makes a difference for me winning a site in a new public tender over another type of company. How does technology differentiate us versus how much does service and reputation and understanding and specialty actually kind of make a change?
Yeah, I think it's been another tough year. I think from an industry standpoint, we said it a year ago, I heard it 2 years ago, people are waiting for this shakeout to come, but companies are able to hold on a little bit longer than you might expect. So us at Monta, we feel pretty bullish about the position that we're in. We have raised a fair bit of money. We have, I think, the most charge points connected to a CPMS in all of Europe. So we're in a pretty strong position here to be one of the winners in this space. And I know we've heard it before, like, waiting for some apples to fall from the tree and maybe we can scoop some of those up a little bit. But, companies can keep going. And I think they're going to keep going in 2026. I think if you're sitting around waiting for others to fail, that's not a good strategy. We're not doing that at Monta or anything.
No, of course.
But we have to keep kind of doing the right things and delivering well for our operators and providing them with the competitive advantage to go out and win, giving them the tools they need to build these profitable businesses. Because like I said, we're wholly dependent on them. And yeah, not all of them are going to make it through either, right? Because they might not have patient investors. They might not have cracked the model. They're not seeing the utilization. They're not able to win a couple of tenders and stuff. And so it's just going to be another year of companies kind of hanging on a little bit. And those that have a good product, they're known for good service, they have patient investors, they have a long-term vision, and they stay kind of focused on delivering that. There's a shakeout in terms of like, oh, companies failing. I'm not rooting for any company to fail or anything like that. But there's also a shakeout of companies being known for quality and being able to deliver, and companies that are not necessarily being known. Like we said, there's more data now available on hardware performance, on software performance, on utilization. So companies can make more informed buying decisions than they could 5 or 10 years ago. So I think there's also kind of a shakeout in quality of like, all right, can that cream continue to rise to the top? Can hopefully Monta be one of those ones that is known for that quality in the industry? Is like, all right, here are the winning CPOs, here are the winning operators, here are the winning software, here are the winning hardware. And I think that'll start to continue to separate in 2026.
Yeah, exactly. I think so too. I like the kind of more positive spin as well you put on 2026. I think next year we'll see some real standout winners in some big markets that are trying to, really focus on a specific area. There's going to be a lot of fun things or interesting things that happens next year. The flexibility markets are starting to open up much more and become more mature. What role are we going to be able to play within the UK, for example, then also France and maybe Belgium. So I feel like there's also new use cases that it's opening up for operators they can start to really take advantage of in 2026 too.
We'll keep tabs on everything for you.
Yep.
But I want to say thank you for a wonderful 2025, Mike. It's been a pleasure, as always, to host In Between Charges. We had a lot of great guests.
We have had a lot of fantastic guests, so thank you also to everybody who's joined us.
Yeah. And we look forward to a big 2026.
Exactly. Yeah, so this is going to be aired in January. So we hope you had a fantastic Christmas and a really great start to the new year. We'll be releasing more episodes throughout the rest of the year and getting on some more fantastic guests, operators, technology companies, integrators, businesses that are really starting to make waves and continue to make waves in the industry. So we hope you continue to tune in for more.